The investing community is polarized regarding the topic of options. Real quick are some investors to write off all options as risky, speculative type investments that serve no real purpose in a long term investor's portfolio. On the flip side, other investors fall in love with the leverage that options provide and fail to acknowledge some of their downsides. By the end of this video, you'll know why there's an option strategy or two out there that might be right for you. A quick note, this video is not going to be an options tutorial, so whether you have lots of experience investing in options or no experience at all, you're going to get a ton of value from this video. Real quick, a 30-second history on options. Options were invented in the 1920s. At the beginning, option contracts were largely used as insurance. In the investing world, we may hedge a position, which is just another word for insurance. For example, an individual who owns 100 shares of XYZ stock may buy a put option as a hedge to reduce downside risk. In the early years, the terms of an option contract were agreed upon for each and every new contract. Eventually, this changed. Option standardization came about in 1973 and made it so that one contract represented 100 shares of the underlying stock. Strike price, expiration date, and other terminology were also standardized. These changes resulted in greater option volume and liquidity, which helps narrow bid-ask spreads and enables option markets to be more efficiently priced. Simply put, option markets became more usable. Because of all this, and the fact that low-cost or even zero-commission option trading now exists, means that the barrier to entry for trading options is at an all-time low, which is a bit of a double-edged sword. On one hand, it's great for responsible investors, but it's also negative for folks who are going to YOLO a bunch of money and have no clue what they're doing. The reason that someone would want to buy an option contract is because options provide leverage. Leverage allows a person to generate large investment returns with a relatively small change in the underlying stock price. As you may or may not know, buying a call option contract is a bet that the stock price will go up. On the other hand, buying a put option contract is a bet that the stock price will go down. The specific parameters of the option contract dictate the likelihood that the trade will be profitable, which has a direct impact on the price a buyer is willing to pay for that contract. Most people immediately see how they can use options to risk their money to generate large returns, but options can also be used to reduce risk. For example, if you own XYZ stock, you may purchase a put option contract to protect you in case the stock price goes down. Even though the value of your shares will go down if the stock price decreases, the value of your put option increases. This is a hedge against your position, thereby decreasing your risk. So far, we've only discussed option contracts from a buyer's perspective. As a buyer, we're the one who pays the premium in order to get access to leverage. As an option seller, we're the one who receives the premium, and in the case of a call option contract, if the price of the stock at the time of expiration is below the stock price, we are able to keep our shares and we keep the premium. As an example, let's say you recently purchased 100 shares of XYZ stock at $25 a share. You like this company for the long term, but you are concerned it may downtrend in the short term. You may choose to sell a call option contract in order to reduce your downside risk. So, you decide to sell a call option that expires 1 month in the future with a $28 strike price and collect a $50 premium in the process. If the stock downtrends during the month, you will still incur unrealized capital losses from the share price decreasing, but you mitigated your losses by selling a call option. You still hold your 100 shares and you get to keep the $50 of premium you collected for selling the call option. You were already going to buy and hold the stock anyway, so the $50 of premium is just icing on the cake. So, what are you giving up when you sell a call option? There's no free lunch. As the call option seller, you give away the upside on the trade. If XYZ moons to $30, you sell your shares for $28, keep the $50 of premium, and miss out on the additional capital appreciation from $28 to $30. That extra profit goes to the buyer. The downside risk reduction comes at the cost of reduced upside. The bottom line is that if a person is going to buy 100 shares of stock, this investor takes on more downside risk if they do not sell a call option contract. Selling the call option contract reduces risk. So, if you were a person who thought all options are just evil, scary little monsters coming to take your money, it's just not true. In this case, selling a call option contract reduces your portfolio's risk. Now you might be wondering about selling a put option. What are the differences there? A put option seller collects a premium and agrees to buy 100 shares of stock at the strike price if the share price goes below that strike price at expiration. If the strike price is $25 and the price of XYZ is $24 at expiration, the put option seller keeps the premium but will be forced to buy 100 shares at $25. So when might it make sense to sell a put option? Let's say you're doing research on ABC stock and it looks like an attractive company. You want to own the company and would like to buy in at $20 per share, but it is currently trading at $22. You might do what a lot of investors do and enter a limit buy order for $20 so that when ABC drops, you purchase 100 shares at $20. Or you might decide to sell a put option contract with a $20 strike price each week. If ABC stock is less than $20 by the end of the week, you will buy 100 shares at $20, just like you would have if you entered a limit buy order. On the other hand, ABC may not reach the $20 price level. If this were to happen, in the case of a $20 limit buy order, it would just sit there tying up your capital and producing a 0% return. However, if you sold a $20 strike put option each week, you would collect premium while your capital is tied up. Even if ABC never goes below $20, you still make money. Selling put options is a hedge against the stock trading sideways. There are an endless number of option trading strategies, some of which can get very complicated, particularly the ones that involve multiple legs. Hopefully by this point in the video you can see that not all option trades are the same, and therefore not all options carry the same level of risk. Some option trades actually carry less risk than just buying ordinary shares of a stock. There are even more examples that I didn't include in this video. In future videos, I'm going to be showing you in real time with screen recording some of the option trades that I'm making. That way you can see practical examples of option trades instead of just a theoretical discussion like you've seen today in this video. This is not going to become an option channel, but like I said before, I will be discussing more option-related content in the future. Hopefully, if you've previously written off option trading entirely, this video has challenged your perspective and shown at least a few examples of how options can be used to reduce risk. If you've made it this far in the video, thank you. If you want my face to show up in more people's YouTube homepage, please hit that like button. And in the comments below, let me know, do you guys trade options? And if you do, what sort of options positions do you currently have open? Before we conclude this video, let's jump into a quick portfolio review. Let's talk about options in today's portfolio review. As you can see here, I have several option positions in this account. Most of them are short option positions, meaning I have sold the contract. One of the positions is a long option, meaning that I've purchased the contract. This first one here at the top is the Dropbox $31 strike call option with a July 16th expiration. I have 4 of these contracts. There's 400 shares on the line. Now, if the stock price for Dropbox is at or below $31 at the time of expiration, I will keep my premium and I will keep all 400 shares. If the stock price is above $31 at the time of expiration, what I'm going to have to do is forfeit all 400 shares. I'll give those shares away and I'll sell them at $31 a share. So if the stock price is $35, I will have to give all 400 away and I will sell them all at $31 a piece. I will miss out on that $4 spread on all 400 shares. Next, we've got Smile Direct Club. Same thing with this call option, just different numbers and different strikes. We got same thing again here with the Tattooed Chef 40 strike call option. The next one here, the next concept, is this put option that I've sold here on Tattooed Chef. It's a $17.50 strike put option expiring July 16th. There are 4 contracts, so there's 400 shares on the line. Now, this one's a little bit different. If the stock price is at or above $17.50 come expiration, I will keep the premium and I will not have to buy any shares. If the stock price is below $17.50, I will have to purchase 400 shares because there's 4 contracts at $17.50 per share. So, as you can see, the call options and put options operate a little bit differently. The collateral for a short call option is shares. The collateral for a short put option is cash or buying power in your brokerage account. Now, let's move over to the spreadsheet. As you can see, I keep track of the option moves that I am making. All of the premiums that I collect to open, I have in this column, and to close here with a profit column on the right side. And then I keep track of all these. I've been selling options for a lot longer than a couple months, but I just started tracking them as of April. Back to the portfolio, I want to talk about strategy. I've been selling call options on Dropbox for quite some time, and I'm going to continue the strategy that I've been using into the future. I enjoy selling call options in this company because I'm very familiar with the price movements. It's not extremely erratic. It's a more stable stock, meaning that I'm a little bit more confident in the call options that I am selling. And if the price of the underlying stock goes above $31 in this particular expiration cycle, I will simply roll the option into a future expiration cycle. Let me break this down for you. So let's say Dropbox stock price goes to $31.50. What I can do is I can buy to close this option. So I just close my position. I already sold it, right? And to close an option position that you've sold, you have to buy it back. And then I will immediately reopen a new Dropbox call option in the future. Because I'm opening it in the future, that option will have more value. There are two things, roughly speaking, that give options value: time and volatility. The more time you have, the more valuable the option is. The more volatile a stock is, the more valuable it is. Since I'm kicking the can further down the road, I am now working with options that have a greater value. What I can do is I can increase the strike price on that option, and the increase in time value will outweigh the decrease in value that I'm taking on because of a higher strike price. All this means is I am able to use a new strike price, a higher strike price in this case, in the future and still collect money to do that. That is called rolling an option. It's a strategy that a person gets better at. There's a little bit of intuition that comes into it. I'm not going to go into all the nuances in this video, but suffice it to say, even if a stock option gets in the money, we're able to roll this position and stay alive. So that's what I've been doing in this account. Hopefully you learned a thing or two, and if you did make it this far in the video, please like the video. Thanks so much for watching, and until that next one, peace.